Here, CEO of Good Life Property Management. Super excited to run you through this wealth building calculator. Let's jump into it. So the reason we built this, there's a lot of calculators out there to analyze investment returns, but there's not a calculator that speaks to the appreciation investor, the person that buys or owns in not a cash flow market, in an appreciation market like Southern California. Because most of the calculators out there, they're good at calculating return on equity or cash on cash return or internal rate of return, but they don't really show the average, let's say, homeowner who doesn't maybe understand all those more sophisticated metrics, just like why owning a rental property is a benefit to them, like how it changes their financial picture. So let me walk you through this. I used a real property we brought on in July of 2025. It was purchased in 2020 for $511,000, 20% down, 3% interest rate, 30-year term, not interest only, but you can put that here if you'd like. So the monthly rent currently is $3,100. So by default, there's a 10% management fee. You can adjust this up and down, but this is meant to be all encompassing. So even if we charge an 8% management fee, we have a leasing fee, an inspection fee. So just figure 10% just as a nice round number. Insurance, you can move this up or down, but let's say $150 a month. Real estate taxes, usually about 1.1% of the purchase price, roughly. Now, repairs and maintenance, this is something most people don't factor in, but it's really important you do, or else you're just going to get frustrated when you go into rent your property, because repairs are going to come up and they're going to need to get done. And if you don't budget for it, it's going to be more frustrating. Utilities, usually for a single family home, in this example, we can pass that on to the tenant, but I'm just going to account for $20 a month. Let's just say $240 a year. Maybe it goes vacant and we have some SDG&E bills and whatnot. And then there's a little miscellaneous in case something wasn't captured that you want captured. All right, now it goes down to tax and appreciation. So the depreciable value. So depreciation is one of the biggest tax benefits you get. And the way it works essentially is you can depreciate the value of the building over 27 and a half years, but you can't depreciate the land. So that's why we say 85% roughly. Again, you can adjust this, but if you look at your tax bill, it will say how much they're attributing the value to the land and how much they're attributing to the structure. And it's one of the coolest expenses you get to write off, because it's like a phantom expense. It's not even a real expense. Basically, the IRS says after 27 and a half years, your house is going to be rubble and worthless, but that's not the case. But it's a cool tax break for landlords that you don't get to write off when you live in a property. So, and then at the appreciation rate, traditionally 5, 6, 7, 8%, depending on the market. Let's just say 6%. And so if you go up here, you'll see very simply your monthly cash flow. So this one's $100 monthly cash flow positive, annual cash flow. Now, the cool thing about that is we have a lot of clients in the situation where they're like, oh, I'm just breaking even. This would be a total break even property, right? Because, that could get wiped away in 1 month, or that $1,200 one water heater, right? So you're just breaking even. So why would I hold a property I'm just breaking even? Well, let me show you. Annual tax savings. So $5,528. This is essentially the cash you're actually saving by owning just this rental property. Now, big caveat. They're not licensed tax people. This is not meant to be tax advice. Please check with your tax advisor. I just want to educate owners on some of the key concepts in owning property. And, there's a lot more to this than meets the eye, like depending on income or depending on whether you're an active investor or a passive investor. But just know whether you can write off all those losses in year one, or if you have to write them off over a period of time, or ultimately, when you sell the property, you will get those benefits. But check with your tax advisor to know exactly how this will affect you. This is purely for informational purposes. Here's the next really cool one that most people don't think about: principal paydown. So this is amortization of the loan. So you have a loan, and every month the tenant's paying rent, and it's going to pay off that loan balance. So in year one, for example, the tenant will have paid off $8,500 that you owe the bank. Now, technically, that's not cash in your pocket. That's why a lot of these cash flow calculators for like more sophisticated real estate investors don't take into account some of these things like the tax savings, because they're just so focused on cash flow, and they'll get some of these other things if they can get it. And they need to be focused on cash flow because they're in cash flow markets where usually the property is not going to go up in value, or they're not going to have some of these other sophisticated, want to pay attention to besides cash flow. So principal pay down, $8,500, and then projected value over 30 years, and then a total profit if you held it for 30 years. So if you open up the monthly cash flow, you'll see everything here that you put in on the inputs. And we tried to make this really simple. You even have an annual one that shows years 1 through 30. Here's that amortization schedule I told you about. This is this figure here, principal pay down. So every month, like let's say you just bought the property, right? More than likely you've owned it for a little while. So these numbers would be adjusted. But basically, initially on this loan term with that interest rate, you're going to pay about $700 a month in principal. So let's say the tenant's paying $3,100, every month they pay that, $700 of that is going towards principal pay down, which ultimately grows your wealth, right? And then over time, as you'll see, how amortization works on loans is you start with paying more interest than principal, then over time it shifts. See, now in month 45, you're paying less interest and more principal. Now, after you get to let's say 5-year mark, it's starting to get pretty close. And that's what's cool about having a really low interest rate and why it's such a valuable asset for people. They can turn their home into a rental and you get the real estate pays as a benefit for them financially. And then over time, if you're not going to refinance a 3% loan anytime soon. So over time, you get month 122 and now you're paying more principal down than interest. And so you'll see over the course of the whole loan term, the interest continues to go down. And that's what's great about rental property is usually the first 5 years is the most painful because you're below, the rents are what they are, but over time rents tend to go up. And so if you stay in the game long enough, it starts to become a lot more rosy financial picture. Then you have your tax savings annual, and this also takes into account, this is a small cash flow amount, so it doesn't change much, but let's say you had a negative $500 a month. That's also a tax deduction, right? So you get to write off your losses depending on your situation, either in that year or over a series of years or when you eventually sell the property. But you'll see in this example, you get to write off $15,000, almost $16,000 depreciation alone off of your income tax. So what we did is we took your tax bracket here. I just put 35 and account for state and local in this. So it could be higher, it could be lower, but let's just say 35%. So you basically take that number times 35% gives you this number adjusted if there's any positive or negative cash flow. But that's like a $5 write-off. That's like an actual $5,500 money in pocket that you don't pay Uncle Sam for owning this rental property. And then lastly, the appreciation. So it's funny, I'll get owners who rightfully so will call and be like, hey, I'm just breaking even on this property. I'm making money. I want to sell it. And we're like, okay, we can help you think through that. And selling might be the right thing for you. I just want you to look at a few things. First off, let's say you've owned it for, let's say 5 years. They bought it in 2020. Okay, so you've made $166,000. You probably made way more than that actually, because buying in 2020 just happened to be the best time to buy a rental property, I guess, besides 2027 or 2017 or 2018. But there was that big run up, right? And so people don't always factor in the appreciation. They don't always factor in the tax savings. And they definitely don't usually factor in the amortization. So the principal pay down, because this monthly cash flow doesn't even count this principal pay down. So really, you're making $100 a month plus the tenant's paying off $700. So really your nest egg, let's call it, is growing by $800 a month just on cash flow and amortization alone. Once you factor in the tax benefits, the tax savings, and the appreciation, that's where we get to these numbers. And that's where you can see, holding it be a really nice long-term play. One day, if you decide to leave it to kids or family, your people that inherit it can get a stepped-up basis. So ultimately, they even pay less in taxes. So it's just a cool tool to play with. Let me know what you think. And if you have any questions, we'd love to help you kind of think through this and help you make the right decision for you, whether you rent or sell. Thanks.